Well, hello everyone. I'm Rick Benson. Today is Tuesday, January 31st, and welcome to this week's In the No Trader show. On tap for this week, we're going to get very specific into one subject only, and that is what's your game plan for trading key economic releases and events, as well as corporate earnings? How do you approach that? What do you do when you know that you've got a position and a name that, let's say, is reporting today or tomorrow? We'll talk about that. Before we do, let me just review for you what we offer here at In the No Trader. First off, we have a weekly tactical ETF trader report, generally comes out Thursday evenings, goes across the 4 asset classes with a deep dive into what the bond market is telling us, including there, we often look at credit spreads for the clue that gives us towards how the market is perceiving risk. We'll look at the US dollar and its implications for price movement and how it could affect stocks. We'll often look at the gold market and perhaps crude oil. And then we do a deep dive into the S&P. It is a very well thought out grouping of all the major factors when it comes to the markets that can affect the US stock market. Then I give you a new ETF trading idea each week, as well as review all open positions that we have until they're closed out. That may include perhaps changing a target or tightening up a stop, but we walk you through every trade until it's closed out. That's our weekly tactical trader report. I also have a 7-11 report. This is a monthly report that comes out generally on the last day of the month, and will reallocate 7 of the 11 spider macro ETFs like XLK, XLI, XLRE for real estate, XLY consumer discretionary. There are 11 sectors to the market. The 7-11 report puts you in no more than 7 of the 11 sectors in any given month. And just to show you the results that we've had in the past, in 2022, we outperformed the S&P by just over 6%. So we are fully invested 100% of the time. We're just not in the entire market. We're in 7 of those 11 sectors. We outperformed 11 of 12 months last year. Since we started this in August of 2020, that's now a 29-month history, we have outperformed by just about 11.8%. These numbers put us at the very top of all those who benchmark to the S&P. We're having a little bit of a rough start this year because of so much price movement in the sectors to start the year, but it's not uncommon for January to be a tough year. Nonetheless, historically, we have way outperformed the S&P, and this is something I think you should consider for any of you who have money in the passive ETFs. This is a great way to potentially beat the S&P, being invested in the market. And for any of you who have exposure to passive ETFs, this is a way of portioning some of that into this type modeling to hopefully outperform the market. And you can see we have done that handily over time. You're probably watching this on my YouTube channel. That's In the No Trader. And you can sign up for that at youtube.com/InTheNoTrader. Of course, I tweet not with a lot of frequency, but you should go to Twitter and start following also In the No Trader, and you'll get those type public commentary things that I occasionally put out. So that's what we've got for that. So let's get back to this idea of what's your game plan for trading those key numbers that really affect the market. And I'm going to take no reason to screen share any longer, so I'm going to stop screen sharing and essentially just put myself full front and center for you. So let's talk about this. Let's break this down into 2 schools of thought. One school of thought is, I think I can outsmart the market. Or choice number two is I know that I can outsmart the market, but I might get lucky. So let's break these down one by one. The first one, I think I can outsmart the market. So let's use tomorrow's FOMC announcement as our real life example. There is consensus on the street that the Fed will raise 25 basis points. Afterwards, so that's a 2 p.m. Eastern Time announcement. We know at 2:30, Fed Chair Powell is going to conduct a press conference. He is going to make opening remarks regarding the Fed's rate change. And then there'll be a press conference afterwards where he takes questions and answers them from members of the press. Think of yourselves as a Mission Impossible agent. Your job is to, if you choose the mission, is not only to figure out what the Fed's rate change is going to be, but then also figure on the language and the tone that Powell uses when he makes his opening comments. And then thirdly, you need to foresee what the investor's reaction is going to be to all of this, because it really comes down to what has the market priced in up until that point, and what are investors going to do going forward to all this news, information, language, tonality of what he says. So trying to plan this all in advance to have a position on a trading position. I'm not talking about investing now, but let's say a trading position. This is no easy task to figure out what the rate hike will be, what his comments are going to be, how he answers the questions, what his tone will be, how hawkish or dovish might he be. This is what you would all need to anticipate beforehand if you're going to have a trading position and carry it, the full-size position, into this event tomorrow. In the second scenario, where you kind of know that you can't likely outsmart the market, and you position yourself accordingly for that. But here is you wait for the news to come out. You then hope that you have the ability to already know what was priced into the market. You hope that the rate change is what you expected. You hope that Chair Powell doesn't say something that's totally unexpected. And then you also hope that you have been able to properly anticipate how investors are going to react to that news. So look, sometimes you get, let's say, an earnings report that comes in as expected, and yet the market will make a dramatic move higher or lower. So you might have done all your homework and you correctly anticipated that earnings were going to come in line, and yet the market makes a significant move. What happens when we see an earnings report significantly beat the consensus estimate on the street, and yet the stock dives? And you say to yourself, well, they did better, but investors are selling off this stock. What's the deal there? That doesn't make sense. These type scenarios come up all the time. And if you think that you can consistently anticipate all the different pieces of the puzzle, think about too that in an earnings report, let's say it's not the Fed announcement, it's an earnings report. After the earnings report comes out, the company does a conference call. And usually it's their chief financial officer, it might be the CEO, who then gives comments to the analysts on the street, and the press is on that call too. And it is then the interpretation that investors have to do of what that CEO or CFO is saying. that can often change everything about the numbers. The numbers are the numbers, but then it's all the underlying information that comes from other people in the comments or how they make their comments. So now it's not just the words they use, but it's also the intonation of the words they use. And this is what the game has turned into. So, choice one kind of is, I think I can figure this all out and I'm going to position accordingly. Choice two is, I know that I really can't outsmart the market, but, maybe you get lucky. And I can't give you the answer of which one better fits your style of trading. I can tell you that personally, for me, after being in this game for 40 years, it's actually a little bit more than 40 years, your ability to consistently anticipate all these factors that go into why a price moves the way it does after a key announcement comes out is not very high. In other words, it's very tough to consistently get this game right of guessing what an earnings report will be. Will the market interpret the earnings the same way, where earnings better but bottom line growth isn't? Were both of those better, but then the in the conference call they are guiding lower for future quarters? There are so many factors at play. And I can tell you that it's very tough to anticipate this with any consistency and keep getting this right. So I typically take down trading positions going into these key numbers that can really move a market. And certainly right now, with the focus on the Fed as much as it is, on the fact that this week also includes a slew of earnings reports from some of the biggest names out there. This is potentially the most important earnings week of the whole earnings season. And it's at the beginning of the month. So on Friday, you also get the employment report coming out. This week, to properly guess which way the market is going to react to all this news is very difficult. And that is why I, at least personally, take down exposure on the trades I have on, shorter term trades that are kind of more tactical in nature, and not those that are longer term investments necessarily. Let's say, if you want, as an example, if you want to own Apple just because you think it's a key name to own and you're not trading it, it just sits in your account. It doesn't matter if it's Apple or a host of other names that you just think are names that you want to have for the long haul, then this isn't really relevant because you have a 5-year, 10-year, 20 or 30-year time hold. You just want those names. Then, the day-to-day and month-to-month information isn't going to change what you do. But as is the name of my website and the fact that this is more about shorter term trading, I don't mean buying on a Tuesday and selling on a Wednesday, but generally we're in that swing area of weeks to months type of holdings. Then these numbers really are important. And it is very difficult to figure out what to do going into these other than to take exposure down. And again, this is my opinion. You may not do this, but I'm just giving you mine. So I take exposure down. I usually take exposure down not only in winners. So let's say I've been bullish the month of January, which I have right from the get-go. I came out of the blocks this year with a tactical bullish bias, and most trades I've put on are bullish trades. But going into tomorrow's report, I am reducing the size of those trades, because if it ends up being bearish news and the market interprets bearish news as bearish news and they sell the market down, then you could quickly see a fair amount of January's gains disappear. If it's bullish news and it continues higher, then I'll still be making money. I won't be making as much because I'm going to reduce exposure. But I also do this with my losses. So if I have, I don't happen to have this on, but let's just say I was short some calls and they've been moving up this month, as most stocks have been. And let's say I was down 40%, 50% on a call option. I would likely take down half of that exposure also, because I'm not looking to lose 100% on any option position. If I can avoid that, I try not to lose everything. And if I'm short a call and the market's been moving up and I'm losing money, and then after the Fed announcement, the market comes off, I'll be regaining some of the loss, right? I'll be minimizing it, but I also want to reduce some of it in case the market just keeps going higher. So my view on all this is, when you go into some of these key numbers that really can affect the market, whether it's stock specific or in the case tomorrow of the Fed, which is going to impact the entire market. And I think it's probably fair to say that this week will impact the market at least through mid-February. The CPI, the CPI number comes out February 14th. So at least for the next couple of weeks, if not longer than that, what goes on this week is going to be very important. So I can't guess which way. Obviously, there's been a bullish move to start the year as shorts are getting forced to cover, as new money has come in, as some people think that the Fed should be done. The bond market is kind of forcing the Fed to consider reducing the size of the rate increases, if not halt them. I don't think Chair Powell is necessarily going to listen to the bond market, but that's what the bond market is suggesting, having already hit in the US 10-year 4.33% last year, and now we're about 3.53%. So we're 80 bips lower than what the peak was. That would not be happening if investors really thought that the Fed was going to keep raising rates at the rate they are. And the market is saying that the Fed should be close to the end of this. So there's all these things to consider. And I generally, my thought process is reduce exposure into the totally unknown. And that's just how I do things. Again, you can do as you wish. But I wanted to make this week's webinar specifically about this subject and nothing more than this, because this is a very important week in the markets, and you're going to have plenty to deal with between today, Tuesday, and Friday's close. So that's it. I wish you good luck trading, as always. And I'm Rick Bensignor, and this has been In the Know Trader.